Welcome to this week's episode of Investment for Beginners. My name is Manuel Maurício. You can find all about me over at allinstocks.com. Over to you, Michael.
Hello, Manuel. My name is Michael Wiggins Oliveira from Deep Value Returns on Seeking Alpha. Manuel, what are we going to talk about today?
Today, I've brought a topic which is everyone's talking about inflation, right? Is it transitory? Is it not? Is it here to stay? So I decided to learn a bit more about inflation. There's one document on all the quotes by Buffett, on all the articles by Buffett, by Warren Buffett, of course, on inflation. I read it and I picked one article of his from 1977 on Fortune magazine. But prior to that, we were talking prior to hit the record button of how you're feeling today, and you were saying that you're. What exactly are you feeling today, Michael? Before we go to our inflation talk.
It's been very, very difficult. The last 4 weeks, I would say, has been really difficult. I said before going into Q3 earnings results that depending how the market took the small cap names, it'll be really indicative of how things are going to unfold over the near term, over the next 6 months or so. And the large caps came through and everyone was kind of happy. No big kind of surprises there. Everyone was really, really happy. And then we started going into kind of the mid caps and the low caps, really kicking off. I don't know if it was Roku or Peloton, I can't remember this, but like when that kind of kicked off, we moved over to the lower caps. It's been like all the companies are basically, irrespective of whether they've reported a beat on the top line or not, they've just been absolutely killed. So I'm just going to go through a few names very, very quickly. I don't spend a lot of time on this, but Peloton, Roku, Asana, DocuSign. These are just some of the names that kind of that go through my mind right now. You can throw in there some Teledoc. I mean, it's been really difficult. Yeah. Which one? Say?
Square weeks as well. That's
yeah.
Every week or every few days or so on Twitter, there's someone updating like a table, an Excel table with the name of the stock and the return from or the drawdown from the all-time highs, and it's in some names it's a bloodbath.
Yeah, it is. It certainly is. And I mean, if a person, which nobody does, but if a person has more than a 30-day horizon, man, this is a really good time to be investing. That being said, everybody knows December is the month for tax losses. So anything that's kind of in negative territory right now, this is just going to be absolutely just sold. So with that aside, I mean, nobody really in this market right now has more than a 30-day horizon, because like if you're a big company management and big hedge fund manager, you're not going to come out with a new pick right now, because at the end of December, you get your bonus and you're not going to be able to kind of go and say, invest in PayPal, for example, because that's going to be tax lossing all the way down. So you're not going to, it's career risk. If you're not a professional investor, if you're kind of somewhere lower down from the scale, you're not going to bother to, nobody has more than a 30-day horizon. I mean, so it's a really interesting period. If someone has the ability to invest and close their eyes for 2 years, man, you're going to get some terrific returns from here. Now, let me just caveat that. Let me just say that. I have absolutely no idea how the market's going to go over the next 30 days or even the next 90 days. Absolutely no idea. It can go down significantly. What I am saying is that from here, from this point, over the next 2 years, I suspect that things will clear up quite a bit. How do you feel? How do you see things?
Most of those stocks that are down big from all-time highs, I don't know them that well. I know Wix, I know a few others, not a lot of them. I return the question to you. The question is, even with 50, 60, 70% drawdowns, are they cheap or not? So the question is that.
No, I think they're amazing. I like a lot of these businesses, like I own, like let's say Upstart. Upstart makes a terrific amount of cash flows. It's a high profit gap GAAP profitable business. It makes approximately 7 to 8% GAAP net income. So it's after tax, it's after interest, it's after stock-based compensation, it's after all intangibles being amortized. It makes a meaningful amount of interest of income as a percentage of their revenues, and they're growing very strongly. I can throw you other businesses as well. So Digital Turbine is a business that I own, and Digital Turbine, it's present in approximately 1.2 billion mobile phones. It's 70% Android based. So if you, for example, get a new phone, you're going to install the software on the new phone. And if it's Samsung or if it's in the US, it doesn't matter. So it's a global thing. So if you open your Android device, it comes with 4 or 5 apps installed in it, and you don't know what those apps are going to be. But someone has paid for those apps to be there, whether it's Uber or Netflix or Disney Plus or whatever. It's an advertisement, and you're much more inclined to use that app if it's already installed in your device, which you keep in your pocket. And this is a business that makes a substantial amount of free cash flow. We talked about PayPal at the start. I don't own PayPal.
Michael, let me pause you on your tracks. I was not talking about profitability, although it's important. I was talking about how cheap are these stocks even after.
Oh, cheap. I misunderstood. Sorry. Sorry.
Even
Yeah,
after
I believe the business
50%, they can still be expensive. And clearly, you think that some of them are cheap because you're invested in them, and most of them are not. So I don't have that strong of opinion, but
no, I think that there's bargains. There's totally bargain. So I'll just finish on Digital Turbine. So Digital Turbine right now is priced at approximately 35, 37 times free cash flow. It's a business that's growing at somewhere between 70 and 80% year over year compounded. So at 35 times free cash flow, you can buy, for example, something like Microsoft. Microsoft on the top line is probably going to grow at approximately 12 to 15%. So you can buy Microsoft that is priced at 35 times free cash flow, and it's going to grow at approximately 12 to 15%. I know it has some share repurchases, et cetera, but just kind of for context, if you move up to the mega caps, they don't have that much growth. They have some growth, but you're paying a very large premium there. And so is that fair value? I don't know. But then you can these smaller caps, and many of them make a substantial amount of free cash flow, and they're priced very, very cheaply, in my opinion. But anyway, this is just a distraction. This is not like the main topic of today. So yeah, kind of over to you. Let's talk about inflation.
But it's interesting because this topic will end exactly in that, and we'll get to there at the end of it. So inflation and where we're at right now, let's say, well, there's a lot of people thinking about inflation, as you know. We might be looking at sustained inflation. It might be just transitory. Let's see, time will tell. I've got the feeling, and it's completely unfunded, or I don't have that many reasons to think this way, but I got the feeling that it's here to stay, but it might not be here to stay. So that I'm no expert in the subject. I don't think anyone can say that with the reasonable degree of confidence. But I went to 1977, Buffett's article, inflation when Buffett, as of the writing, was 6.5%. And it still went to 13% in the 70s, late 70s, beginning of 80s. Why is this relevant? Of course, because we might be seeing the inflation go up, or even go up a lot. Let's see if they're there or not. And I've got here behind me this question: how to increase the return on equity? Exactly because Buffett compares stocks to bonds. And at the time, he mentioned that investors looked at bonds as no way. So bonds were in no way, how do you say, protection against inflation. But the general idea, the common sense would tell you that stocks are. And Buffett talks about stocks or compare stocks to bonds. bonds with a 12% coupon, or which is the return on equity. So Buffett back then, he went looking and he gathered a bunch of data that told him that corporate America was stuck to 12% return on equity. In some decades, it would have a bit higher, some decades it would have a bit lower, but it was stuck in an average 12% return on equity. So if inflation goes to, let's say, 5%, the equity available for growth would be 7%. That would be what you would gain in real terms, discounting the inflation. Today, and that's where I'm going, we've got much higher return on equities because the industries are quite different from those industries that Buffett saw back in 1977. So Buffett asks the question, how can businesses increase the return on equity? And I've got them the ways to increase the return on equity back behind me. One way is to increase margins, which is pricing power, as we know. The second is increase the turnover over assets, over receivables, inventory, property, plant, and equipment. This, the Buffett said that you might see some increase in turnover, but not a lot. The other three ways is more debt, which is unlikely to happen, I would say. I'm not sure, but I would say. Another way is lower interest rates, lower debt costs, which we in an inflationary environment, and you're nodding with your head or saying no with your head. Of course, we it's unlikely that we'll see that happening. And the last one is lower tax rates. I think it's also unlikely that we'll see that happening. So, what can we say about this? Do you that of course you know Terry Smith from Franz Smith is a well-known investor, and he always talks about pricing power and high gross margins, and he say that he likes to invest in companies with high well-known brands with high pricing power in order to increase margins. That's one of the things. At the end, I will switch the slide, the image behind me, to the ideal, at least until now. What I have come to realize is the ideal business, or the characteristics of the ideal business in an inflationary environment. So the thing is, and for those who are just starting to understand how to read financial statements, there's some connection, or there's a lot of connection between the three financial statements. The thing is, the profits at the end of the income statement, how do they translate to the owner's earnings, or to the free cash flow, or to the true cash that can be taken out of the business? In an inflationary environment, this is a bit more complicated because those profits will need to be reinvested back into working capital and or property, plant, and equipment, fixed assets. At the beginning of an inflationary environment, you might see the returns on equity actually growing because the prices are going up, the revenue is going up, but you haven't yet needed to replace the property, plants, and equipment. Your factory will last for, I don't know, a couple more years, or 5 more years, or 10 more years. The problem with that part of the property, plant, and equipment is when the replacement cycle ends and you need to replace the machinery. So the thing in an inflationary environment is not as much the profits at the end of the income statement, is what you need to do to maintain your competitive position. And it probably will eat away those profits, because just to stay in place, you need to reinvest more in the business. So the thing is, and as you might imagine, industrial business back in 1977, I would say that there was no software, there was no big tech like today. So industrial businesses were a big part of the index and of the industry. So at some point they were capital intensive. At some point the depreciation didn't exactly account for the inflation, because there would be the replacement cost would be much higher than the depreciation. And there's an interesting study I'm not sure if it's Mabosin or Damodaran that says that on average through a long period of time, the maintenance capex is 1.5 times depreciation. So depreciation tends to under report
Mhm.
the replacement value. And
Capex.
let me just switch my background. Exactly. Here we are. So, what is the ideal business to fight inflation? And Buffett understood it when he bought See's Candies, when Charlie Munger convinced him to buy See's Candies at 25 times earnings, and Buffett was really not wanting to do it at first because 25 times earnings for him back at the time when he was a cigar butt investor, or mostly cigar butt investor, paying really low prices, for him was a lot. But then he understood, influenced by Charlie Munger, the power of See's Candies. So the ideal business to fight inflation, and I would welcome your inputs here, Michael, because the longer this list, the better we're informed to invest if we have a long-term time horizon, as I do. So pricing power, high margins, pricing power, two different things, because for instance, food retail, supermarkets, they don't have high margins, they have low margins and high turnover, but they have pricing power. So you're going to buy, I don't know, toilet paper. To give an example, a recent example from the pandemic, and you're going to buy it whether it costs you $1 or €1 or £1 or 120 or 130, you're still going to buy, right? So supermarkets, although they don't have high margins, they have some pricing power or the ability to pass through the price increases of the commodity and of the raw materials. Low maintenance capex, and for that matter, low growth capex as well. And let me shift my head, high flow through to free cash flow. So we want to see that. And at the end, this is a new addition that I've just come to realize, negative working capital. So if you have negative working capital, as the inflation tends to grow, you won't have your dollars or your euros or your yens or whatever currency you're talking about tied up in inventory or whatever. You will actually benefit from inflation if you have a negative working capital. Today, the world is in some ways much different from 1977, and we have all those light asset light or capital light businesses that you like, and I do as well. But you're more into those high flying growth stocks. Today the world is a bit different, so we have or a lot of software companies, and that wasn't the reality back then. So we've got a lot of companies, and I encourage you to contribute. There's a lot of companies now with all of these or some of these characteristics that I have here behind me, right? Mostly software, right?
So one of the things I'll say is that all of these ideas about pricing power, and as you described already, everyone has kind of already maximized a substantial amount of that. The only thing I would say is I'm not a Cathie Wood's follower per se, but what she does say, and you can give it some validity to, is that technology makes everything highly deflationary. So the amount of technology that you need as the supermarket to make the toilet roll, the technology rapidly decreases in price. So you're able to output a lot more toilet roll with the same amount of technology. So at the same price that you pay for that technology, you output a lot more, which would lead to your ability to improve the margins of your business despite having a high inflation. So I don't know, is what I was going to say. These things are so kind of theoretical, and this month it's inflation. Next month it's a new variant. The month after that is it's always something. The fact of the matter is, in my opinion, you can buy some high quality businesses right now So GoPro is a business that I own. It's not particularly high tech. It's not a high flying business. Yeah, GoPro. So GoPro, makes a substantial amount of free cash flow. Approximately something like 13% of its market cap is made up of cash. Once you subtract out the debt, so including the debt, you subtract that out. You have, and that's a business that is quote unquote technology driven, but it's not what you'd think about as a software business per se. It's not really a platform, but it's a business that should kind of benefit from those deflationary expenditures towards technology, because you kind of need to make the cameras, right? The cameras are a hardware product. So these things kind of become a bit theoretical, because I look at, for example, at GoPro, and it's pretty much very close to all-time lows. The share price is kind of around $10 a share, and at the same time, the gross margins of the business are approximately a 6-year high. So there's kind of a big discrepancy, and how inflation is going to affect the business like GoPro over the next, let's say, 3 months or 12 months. I mean, it's semantics. I mean, when the business is priced near all-time lows, and the actual fundamentals of the business are nearly at a 6-year high, there's something wrong with the market, right? So it's like,
I think it depends a lot on our, and I think that's where we diverge, is your time horizon, right? I usually have for what I was able to gather from our conversation, I have a longer time horizon than you. So if your time horizon is 3-4 months, inflation doesn't.
No. I would normally wait at least like a year at the minimum, like at an absolute minimum. Ideally, I don't want to. I would only sell something if I've made a mistake. Mm-hmm. So if I've not made a mistake, I don't want to sell it. Why would I sell it? I only sell it if I can see that. But I don't want to sell too quickly either, because, for example, businesses that are a lot like people, right? They sometimes tumble over, and they need a bit of time just to get themselves back into strength. And you might not see that in 90 days. You might not see that in 6 months. But in the example that I gave you, GoPro, it's a business that it's fundamentally performing at a 6-year high. So meanwhile, the share price is quite low. So it's kind of interesting. So a lot of these inflationary topics have really just destroyed a lot of small caps names, and it's quite difficult, to be honest, because I don't know how this inflationary period is going to play out. It could last several years, as it did when Buffett wrote the Fortune article. That was close to a 5-year period. Or it can be much shorter, and it's very difficult to know. But when you're kind of buying a business relatively cheaply, if you're able to kind of sit on your hands, that's the most difficult thing for investors. For investors, the most difficult thing is to sit on your hands and do nothing, because everyone has the ability to act right now. The share price is up, you've got to act. The share price is down, you've got to act. And it's quite difficult to be able to have that fortitude to sit on your hands. And it's a fascinating business to be an investor.
I own one company that makes meatballs, and they're rising prices because of, not only because of meat or beef increases, but because of freight, because of containers, all of that. And they were saying that whenever they're expecting the high prices that they're seeing to come down in the near future, a few months from now, but they won't drop their prices. They're now raising their prices, and they'll take advantage, seize the opportunity. Even if all the raw materials and freight and transportation costs come down, they'll keep their prices high. So it's kind of interesting. A lot of companies will try to take advantage of this, of course.
And that's why it's so interesting, right? Because everyone is playing that game. Nobody's going to try and reduce their prices. So the raw material input is also not going to, they're going to try and keep their price high. So it's a very interesting situation to be in. Have you noticed, particularly in your experience, that there in the companies that you look at, that there's a large gap between the bigger names, like say like the large cap stocks, and the kind of the stocks that you follow, or you haven't seen anything meaningfully sell off in the stocks that you follow?
I haven't done that exercise yet,
Okay.
it's a nice one, and I'll do it, and I'll get
Mhm.
back to you on our next episode to answer that one. What are you seeing there? Are you seeing the?
I'm seeing a lot of people fly towards safety. Safety is obviously the bigger the company, they've been able to withstand more different economic periods. So people are just fleeing over to safety. And I've also seen I heard some data in Tobias Carlyle's podcast where he talks about that large caps, US, have compounded in the last 10 years at 19%, and that small caps have compounded in the last 10 years at 12%. So there's a very large difference between how the large caps have done. So the more expensive the name, the more expensive has continued to be. And there are reasons for that. We discussed this in many episodes already, that there's the idea that they're able to, like the likes of Google, they're able to take more market share, more market share, more market share. So there is a justification for that argument, and then there's the other justification that they benefited from low interest rates that has expanded the multiples. It kind of becomes quite interesting. I mean, it's fascinating experiment investing. It's very, very difficult. But one thing we can always be clear: in hindsight, all the answers will be provided.
And with that, we're reaching the end of our conversation. You've now, GoPro for me was like Kodak, and for a lot of investors, Kodak. What happened to Kodak? It was because of all the cameras that we now have on our phones. I kind of forgot about it, but now you got me somewhat interested, and I'm going to take a look at it, and we'll talk about it, or probably
Next week.
on another episode. For good, great.
Cool. Thank you so much. Thank you.
See you.